What if I told you that everything you think you know about the Australian property market is wrong? What if the crash everyone predicted isn't coming? In fact, what if the exact opposite is happening right now, under our very noses? For months, we've been bombarded with headlines of doom and gloom. Interest rates soaring, inflation running rampant, and the property bubble finally set to burst. Experts warned of a 15, even 20% drop in house prices. Many Australians, paralyzed by fear, put their home buying dreams on hold, waiting for the inevitable crash. But the crash never came. Instead, something baffling, something that defies all conventional economic logic, started to happen. New data has just been released, and it's sending shockwaves through the financial world. For the third consecutive month, Australian house prices have not fallen. They have risen. How is this possible? How can property values climb when interest rates are at a decade high and the cost of living is squeezing every household? This isn't just a random blip. It's a pattern. And to understand it, we need to unravel a story that's been decades in the making. A story of policy, people, and a deep-seated national obsession that has turned Australian real estate into a financial enigma. To really get to the bottom of this mystery, we have to go back, not just a few years, but to the late 1990s. Picture this. Australia is riding a wave of economic prosperity. The government, led by Prime Minister John Howard, makes a pivotal decision in 1999. They introduce a 50% discount on the capital gains tax for investment properties held for more than a year. At the same time, another policy, negative gearing, which had been around for a while, became supercharged. This tax loophole allows investors to deduct any losses on their rental properties from their other income. Suddenly, owning an investment property wasn't just about rental returns. It was a powerful tax strategy. The message from the government, whether intentional or not, was clear. Invest in property. This lit the fuse. A generation of Australians was incentivized not just to buy a home to live in, but to buy multiple properties as investments. The dream of homeownership began to morph into the dream of becoming a property mogul. This created a fundamental shift in our market. It was no longer just about supply and demand for shelter. It was now a speculative investment market, heavily fueled by tax incentives and the promise of ever-increasing wealth. This is the origin, the DNA of the modern Australian property market, and it's the first clue to understanding why it behaves so strangely today. So, the stage was set. With powerful tax incentives in place, the Australian property market entered a new era. From the early 2000s, prices began a relentless upward march. Sure, there were small dips, like during the global financial crisis in 2008, but the overall trend was undeniable. Property became the go-to investment, seen as safer than shares and more tangible than cryptocurrency. Dinner party conversations were dominated by talk of recent sales, renovation potential, and a new term that entered the national vocabulary, FOMO, the fear of missing out. This fear drove prices to astronomical heights. People weren't just buying homes. They were leveraging themselves to the hilt, banking on the assumption that prices would always go up. The banks, in turn, were more than happy to lend, fueling the fire with cheap and accessible credit. The cycle was simple. Rising prices created more equity, which people used to borrow more money, which they used to buy more property, which pushed prices even higher. During this period, the very idea of a major price correction became unthinkable. It was ingrained in the national psyche that property was a one-way bet. This created what economists call a positive feedback loop, where rising prices justified the borrowing that created the rising prices. It was a golden age for property owners, but beneath the surface, a huge and dangerous imbalance was growing. The affordability crisis was born, and the gap between the property haves and have-nots widened into a chasm. Then came the turning point. In May 2022, after years of holding the line, the Reserve Bank of Australia did what many thought was long overdue. To combat spiraling inflation, they began to raise the cash rate, and they didn't just nudge it, they slammed on the brakes. What followed was the most aggressive series of interest rate hikes in a generation. In just over a year, the cash rate went from a record low of 0.1% to over 4%. For millions of mortgage holders, this was a financial earthquake. Monthly repayments skyrocketed, in some cases, by thousands of dollars. The media went into a frenzy. Economists, analysts, and every armchair expert predicted the end was nigh. The property bubble, which had been spoken about for years, was finally going to burst. All the ingredients were there: record household debt, soaring interest rates, and a crushing cost of living crisis. It was the perfect storm, and for a while it looked like they were right. From their peak in early 2022, house prices across the country began to fall. Sydney and Melbourne, the two largest markets, led the decline. The fear of missing out, FOMO, was replaced by a new fear, the fear of overpaying or, even worse, falling into negative equity. It seemed the great Australian property correction had finally begun. The party, it seemed, was well and truly over. But was it? This is where the story takes its most unexpected twist. The predicted crash, the 20% apocalyptic fall, never materialized. After about 9 months of decline, something strange happened. The fall slowed, it stopped, and then, inexplicably, prices started to creep back up. In the face of the highest interest rates in over a decade, with household budgets stretched to their breaking point, the market turned. How on earth is this possible? We need to look at the other side of the equation. First, a chronic, systemic undersupply of housing. For years, we simply haven't built enough homes to keep up with our growing population. This fundamental imbalance acts as a solid floor under the market. Second, immigration has come roaring back. Post-pandemic, hundreds of thousands of new people are arriving in Australia, all needing a place to live. This surge in demand, for both rentals and purchases, is putting immense pressure on an already strained supply. The rental crisis is so severe, with vacancy rates at record lows, that it's pushing many people who can afford it to buy, just to secure a roof over their head. And third, let's not forget the psychological factor. The buy-the-dip mentality is deeply ingrained in Australian property investors. As soon as prices softened, buyers who had been sitting on the sidelines saw a window of opportunity and jumped back in, convinced they were getting a bargain before the next boom. This combination of low supply, high demand, and investor psychology created a counterforce so powerful it defied the gravity of the RBA's interest rate hikes. The market wasn't just resilient, it was performing an act of economic levitation. So, where does this leave us? Let's break it down into 3 key takeaways. First, the Australian property market is not a normal market. It is heavily distorted by decades of tax policy and a chronic lack of housing supply. These structural issues are far more powerful than the cyclical effect of interest rates. You cannot analyze it using conventional economic models alone. It has its own set of rules. Second, the demand for housing in Australia is relentless and growing. Strong immigration, a tight rental market, and a cultural obsession with property create a constant, powerful baseline of demand that prevents prices from falling too far. As long as we have more people wanting homes than homes available, prices will be supported. Third, the fear of a massive widespread property crash seems to be overblown, at least for now. While some mortgage holders are certainly in distress, the overall market is being propped up by these powerful underlying forces. The predicted mortgage cliff has so far been more of a gentle slope for the majority. So, what happens next? This rebound poses a serious dilemma for the Reserve Bank. If they keep hiking rates to fight inflation, they risk putting immense strain on households, but if they don't, the wealth effect from rising house prices could make inflation even worse. We are in uncharted territory. The resilience of the market is both a sign of the strength of our economy and a symptom of its deepest inequalities. It benefits those who already own property while pushing the dream of homeownership further out of reach for an entire generation. This isn't just about economics. It's about the fabric of our society. The question we have to ask ourselves is not when will the market crash, but rather, is this the market we want? A market that creates so much wealth for some, while locking out so many others. That's the real mystery we need to solve. Thanks for watching. If you found this analysis insightful, don't forget to like this video and subscribe to the channel for more deep dives into the forces shaping our world. See you next time.